Most deals I see are underwritten on a 5-year timeline, but we actually underwrite deals that are on bridge loans on a 3-year hold. And the reason why we do that is we match the term of the underwriting to the term of the bridge loan. So typically bridge loans are 3 years initial term with 2 1-year extension options. We call them a 3+1+1. And that's why we want to match the initial term of the bridge loan with the underwriting. So that way there's no mismatch, right? So, however, I am seeing people do bridge loans that are a 3+1+1 on a 5-year underwriting because it is more in line with expectations, and people generally are used to seeing 5-year underwriting. So that's what people like. And so that's what people are doing. However, what do you do about the mismatch, right? So one thing you could do with the mismatch is you could assume that you're going to exercise the extension options on the bridge loan in order to make the bridge loan full term 3+1+1 of a total of 5 years to match your 5-year underwriting. And then you have to factor in the costs of those 1-year extensions into your underwriting, which I'm assuming most people don't. So that's kind of an inherent flaw right there. So that'd be one solution, right? You could actually assume the execution of those extension options. And extension options can be anywhere from 25 basis points of the loan amount to a full 1% of the loan amount. And 1% of the loan amount is a pretty expensive extension option, and I'm sure that wouldn't look super great in your underwriting if you had to assume paying a point for 2 points for those extra 2 years. So that's not an ideal solution in my opinion, but it definitely is viable. Then the other option is simply to reduce your underwriting period to 3 years to match the initial term, right? And then you assume, okay, we're going to sell after the initial term is up, right? Around that maturity, and you won't need to actually exercise those extension options. So the other reason why we like to do the 3-year option over the 5-year when it's a bridge loan is we're making this assumption or this implication that there's going to be a capital event sooner rather than later, right? So certainly our plan isn't to exercise those extension options. That would be only in a downside scenario where you'd actually need those extensions, because the goal when you go in on a bridge loan is to quickly implement your business plan and then get out of it, either through a refinance or a sale. And with a 3-year underwriting, we're making the assumption that we're going to exit the bridge loan in 3 years or less. And like I said, it can be either done through a refi into a permanent agency loan, which will be longer term, lower interest rate, and have more years interest only, right? Which is great for the deal. Or we'll simply sell, and you'll definitely get an IRR boost if you're able to sell in 24 months versus 36 months. So that's another reason to underwrite on the 3-year term. Now the downsides, kind of what I implied before about the 3-year term for your underwriting, is that it's different. A lot of investors are used to seeing the 5 years, so the 3-year is different. And one of the ways that it's kind of creates dissonance is the equity multiple on a 3-year underwriting is lower than a 5-year. Obviously, it doesn't really matter how good the deals are. If you're holding a deal for longer, your equity multiple is going to be larger. You have more years to cash flow, more years to grow the value of the property per the assumptions of the model. So people might be used to seeing, 1.8, 1.9x, 2x equity multiples, but you're rarely going to see that on a 3-year underwriting. So it's unfair to compare the equity multiple on different timelines. Similarly, a bit more nuanced, it's also not quite fair to compare IRRs on 3-year underwritings versus 5-year underwritings. Due to the time value of money and the way that IRRs are calculated, a 3-year underwriting, all else being equal, will show a higher IRR than a 5-year. And that's simply because you're especially if it's a value add deal, you're creating value up front, and then you're monetizing that value through a sale in 3 years instead of 5 years. So just due to that alone, you're going to have a higher IRR for a 3-year underwriting. And so that's why we actually demand an IRR premium for deals that we underwrite on a 3-year hold. And we only underwrite deals on a 3-year hold if they're a bridge loan. So now if we're doing a 3-year deal on a bridge versus a 5-year deal on a perm loan, right, we have 2 different kind of categories of deals. And they're different in their projected hold period as well as their financing. And both of those carry different risk premiums. One being an implicit risk premium where the bridge loans are typically higher risk than a permanent loan. And so you should demand a higher return for a deal that's financed with a bridge over a perm. And then you have the explicit increase in IRR that's going to come from having a shorter hold period, right? The 3 years versus the 5 years. So that's why we're looking for typically 16 and a half and greater IRR net to investor for a 3-year bridge loan deal, whereas we're willing to accept all the way down to a 13% net IRR for a 5-year underwritten deal with permanent financing, because we feel so strongly about the lower risk nature and stability of underwriting a deal in a 5-year, and more importantly, financing it with long-term debt. So those are some of the ways that we combat the differences between the two strategies. But nevertheless, we get investors, asking questions and pushback, and actually some very interesting pushback, which, we hadn't really put much thought into, but it is a very valid point, is the fact that if you underwrite a deal with a base case scenario of a 5-year hold and you end up actually selling in 2 years, right? You all of a sudden took this business plan that was spread across 5 years and jammed it into 2 years, and you're going to get a much bigger IRR. You're going to crush expectations. However, if you underwrite the deal on a 3-year hold and that's your base case, right? What if you have to hold it for another year and it's a 4-year hold or a 5-year hold, right? Now you're underperforming. So, this one investor that we have was arguing that the likelihood of underperformance is actually greater on a 3-year hold than it is on a 5-year hold. And just, in a vacuum, that's hard to argue. It's mathematically most likely true. But you can simply sensitize the deal across multiple hold periods and look and see, okay, well, from hold periods, 3 years, 4 years, 5 years, all the way out to 10 years, what happens to the IRR? Naturally, the IRR should erode, go down slightly over time, but are we talking like a 50 basis point move, 100 basis point move, 5% difference? So it's good to kind of see that and stress that as a difference, but nevertheless, it is kind of a mental barrier that's hard to get over for many. So question for you is, how are you underwriting deals as far as the hold period if it's on a bridge loan, right? We've got bridge loans, which are typically the 3+1+1 that we discussed, and some are even shorter hold periods with no extension options. And so how do you kind of match that up with the traditional 5-year hold that most people are used to seeing? Thanks for watching.